All right. Hey, we're
We're
here.
there.
We made it.
Yeah.
How's it going?
How you doing?
Good. Good.
Where
Just
are
trying
you? You
to.
down in Crawfordville?
I am. I am. I'm in Crawfordville, just managing all the little rural areas in between Atlanta and Augusta. So that's been
Somebody's
the
got to
latest.
do it.
Yes.
Yeah.
So
Somebody's
somebody's
got to
got to do it because nobody wants to. We're the forgotten zone. Nobody wants to come down here and they either want to be in Atlanta in the city or in Augusta. Nobody wants to do the in between.
Well, but I mean, there's a market down there. There's guys like me buying hunting land and farmland.
That's
You can
right.
always you can always put on your overalls, right?
Yeah, yeah. Oh, I have my boots I have in the car because I do a lot of land lately. So have been doing a lot of walking land, but it's so funny because I invite people to tour the land and then they get there and they don't want to walk it. So I think there's
That's
probably
crazy.
you know a misconception about what you have to do when you own a piece of land or when you're um, doing your due diligence on a piece of land. So
Yeah. Are most of those people wanting to like just live out the country a little bit? I mean, they're not. They just want like a little estate lot, right? Like an
right,
acre to
right.
5 acres or something.
Yeah, yeah, something smaller than 5 acres most of the time. They don't want anything too big that they have to maintain. I think the homesteading craze has made everybody kind of want to be out in the country now. So, but like you said, a lot of farming land or people that hunt or clay shoot as well. Gotten people that come out to clay shoot. So yeah.
Yeah, yeah, you got to be away from everybody if you're going to do that, right?
You do. You do. Absolutely. So I wanted to kind of talk to you. Thank you so much for coming on. I wanted to talk to you about um, financing your home or building your home and what type of financing options may be available to those who may be interested in financing a home versus financing land or building on a piece of land and what that looks like from your side of things, because a lot of people ask me and they don't realize the options that they have with regard to lending and the different products that may be out there to support their needs. So I wanted to welcome Mr. Steve Beecham of Hometown Mortgage, Senior Loan Officer, also a speaker, author, and incredible writer.
I have
Welcome.
somebody do it for me, so I didn't really write.
Okay.
I came
Well,
up
that's
with the
that's our
ideas.
little secret.
Yeah, I go find somebody that's an English major, and I say, can you take this junk and make it make sense?"
Right.
Oh my gosh, that's a
And
funny that story.
yes. So one of the incredible thing is, most people don't know is that we have known each other for quite a while and we didn't meet in real estate, which is so interesting because we have become friends over the years and created this amazing friendship. I know your kids, you know my kids, I know your beautiful wife and you are familiar with my husband. So we have
Your
created a
beautiful
big
husband.
ball. Yeah. So
Well,
I wanted to kind of ask you a couple of questions, and if you're open to it, you can answer them. And I know you're going to be open and honest with me and with my viewers because I want to make sure that everybody that I have on the relocation reset is we give it to you straight. We don't no fluff. And we want to make sure that we're relatable because there are tons of people out there that that are just making it look pretty. But there are days in real estate, as you know, that are not so lovely. So we want to make sure that you're as educated as possible about this financing thing. So in lending today in the real estate market, can you tell me a little bit about where we are today as far as interest rates and the real estate market and lending?
Well, it depends on where we are in the Iran war right now. So it's changed every day. Friday it got really good because it looked like we had a ceasefire. Today it's back up a little bit. I would say the national rate today is probably in the mid low sixes range. It depending on how much you want to pay. You know, um, to give you an example, we were probably in the high 5% range before the Iranian war thing broke out. So my hope is we get through that sometime fairly quickly, get interest rates back down, get into our spring season. And I think if you can give somebody an interest rate with a 5 in front of it, they feel good about it. You know, the average rate, you know, across the last 20 or 30 years is between 5 and 7%, and we're around 6% right now. So it's not that it's out of whack. It's just that, you know, you're able to get it cheaper at one time. And then, of course, the housing prices and the land prices and everything is, I don't know, 25, 50% higher than it was 5, 6 years ago, you know? So it just making it really tough. It's almost like Georgia has all of a sudden become cool. You know, we
Yeah,
were always cheaper than everybody else, and now we're
right.
kind of in there with everybody else. We're the same price as Florida or New York or Dallas and stuff like that. So I just think there's been this uptick, and I don't really know that it's going down unless we have some sort of, you know, recession of some sort. So all the subcontractors are still fairly busy, you know, so there's no reason for me to charge you less for the lumber or for the sheetrock. So it's, you know, it is what it is. And as long as somebody will pay me my price for the land, I'm going to keep that price up, you know.
Absolutely.
I think the biggest thing I see is that, you know, somebody says, hey, my neighbor sold their house for 350, so I'm going to put mine on the market for 360, when really they should put it on the market for about 340. So they
Right.
put it higher, and then it sits longer because it needs work. So the houses that are getting bid up are the ones that are going in the first week, or houses that are in what we call mint condition. The seller, it's ready to roll, because if you're buying in that price point, typically you're first, second home buyer. You don't have a lot of extra money. You're scraping up for your down payment, your closing costs. You don't have money to go to put on a new roof or paint the house or whatever. So that's the biggest thing I'm telling people. If you really want to maximize your money, your house needs to be show house ready. And
Right.
we're seeing that. A lot of people, you were talking about earlier about maybe doing construction loans and things like that. So one of the things that people have to think about or don't understand is that you have bank commercial type loans, and then you have mortgage residential type loans. So
Mhm.
unless there's a residence tied to that property, then a guy like me that's a mortgage guy, we can't do the loan. So we can't do raw land.
Right.
We can't do construction loans because they're short-term loans. So what happens, the process is, if I want to go build my house out in the country, I got to go find the land, and then I got to figure out what I'm going to build on the land, and then I can go get a construction loan that will buy the land and help me build the house. And then when I finish building the house and I get my certificate of occupancy from the county, then I can turn that into a permanent residential mortgage, which is what I do. So if somebody says, I want to go buy a piece of property and build a house, I say, well, if you go buy just the land and you want to sit on it for a while and you don't already have your plans ready, then you need to go get a land loan from a bank, not from a mortgage guy, from a bank. Some mortgage guys work at banks, and so they'll put you with somebody in the bank, but basically it's a bank loan. So if you do a land loan, land loans don't, I mean, land sales don't turn as quickly as home sales. So most of your banks are going to require you to put down 25 to 30% on the price of the land. You can, in some areas, get maybe 20% down, depending on, maybe it's small enough, maybe your credit's good enough. There's some options. But a lot of people have to go buy the land, and then while they own the land, then they got to go get their plans, and they got to price out the plan. And most banks require you to have a builder, somebody that's got a license. They don't
Mhm.
typically want to let you build the house yourself. It's
Right.
possible, but you've got to talk that banker into the fact that you know what you're doing. Like maybe
Mhm.
I'm a subcontractor right now and I already know about construction, but if you're in IT and you want to go build a house, they're
Right.
probably not going to let you do it. Okay.
They're not trusting you.
Yeah. Now, most of the time, because it's a bank loan for the land or bank loan for the construction, 99% of those are done as commercial loans, and commercial loans typically require a minimum of 20% down. So if you were going to buy a lot for $100,000 and you were going to spend $200,000 to build your house, let's say, and you need a total cost of $300,000, they're going to make you put down 20% of that $300,000, which is 60 grand. So a lot of people, that knocks out a lot of first-time homeowners. They just don't have that kind of cash, and because there's a construction element involved, you really can't go in there and do a 3% down loan. There are some programs, but most people don't do them. But there are some programs available where you can get a construction to perm loan for about 5% down, maybe 10% down. And it's usually a situation where the mortgage person works at the bank and the bank is willing to do that. But it's very, very hard to find because
Right.
the banks with the FDIC approval and stuff, they pretty much are doing all their loans with 20% equity in it. It's totally separate entity than what the mortgage people are doing. So I do a lot of those kind of loans, but typically what happens is somebody finds a piece of property and then they go get a lot loan or a land loan, put 25, 30% down, sit on it for a year, get their plans and specs, get their builder, then they get ready to go. And then we turn that land loan into a construction loan, probably at the same bank. And then you do the construction loan for 6 or 9 months. And then when you finish, we put it to a permanent loan. So that requires a couple of closings in a lot of cases. So there's more money. It's more expensive to do it that way. But you get what you want. Typically, if you do that, it takes a year or two to finish that project. You probably have gained some equity in there, so it's worthwhile to do it. I think everybody dreams about doing it.
Right.
As I say, every king wants to build a castle, and some of us
Right.
get to build our castle, and some of us don't, right? But that's
Yeah.
pretty much how that works.
Gotcha. Well, I mean, I get a lot of buyers that come to me and they want to purchase land and they don't know what that entails. They just know that they want to own a piece of land, maybe eventually put a manufactured home on it, maybe eventually build a home on it, like you stated, but they don't know the ins and outs of what those different processes look like, and also what the funding looks like for those processes. And so that is, it's a huge education piece because then we have to go into, okay, well, like you stated, a land home lender is a different lender than someone who would do a land home loan with a manufactured home, which is different from someone who would do a construction loan if you were to build on it, which would be someone totally different if you already have a pre-approval that to buy a stick-built home that's already built. So, just looking at those different options, and I think the average person just doesn't know those nuances of those different loan products.
Well, what
And so, what's
happens if
the
you
biggest
talk to
misconception that you see?
have you talked to many of the guys that sell the new manufactured homes? I would think they would have some resources for that. One, maybe knowing where some lots are available, maybe help
Mhm,
you understand how to put those two things together to get
mhm,
to get a loan. And then maybe you do that and then you come back and see a guy like me later and
mhm,
refinance to a more permanent, maybe a more favorable interest rate. Maybe,
mhm.
they may be a higher interest rate, but maybe not. I don't know. But
And a lot of A lot of the times they are. So there are builder or finance companies out there that will do land home packages, like C21 or Vanderbilt Mortgage. They specialize in those types of loans with the manufactured homes. But yes, they do at times come at a cost. But they because they require the home to meet HUD standards, just like they did post 1979. They require those homes to be built to HUD standard. They can finance them traditional FHA and conventional if they're tied down. And I think that one of the things that a lot of people don't realize is that if a manufactured home is already on a piece of property, we have to find out then if it is tied down. Or if they retired the titles and obtained a deed, which makes it real property. And real property can then be financed in conventional ways that would not otherwise be available to a manufactured home that's on a piece of land that may not be tied down, or that may be an older home, pre 1979 home. So yeah, there are options out there, but like you said, it may be in your best interest to look into conventional financing once you get that home tied down and
You know,
get that
one
better
of the
interest rate.
one of the things I tell people is this USDA loan. I think it's
Mhm,
a fantastic loan. It's got some restriction on it as far as income, but for
mhm.
most people that live out in the country, there's a chance for that. Like Metro Atlanta, once you get above Cumming and Canton, some of those places qualify for USDA loan. So you don't have to get too far outside of Metro Atlanta to get a USDA loan. And USDA loan, you basically get in for $500 down. So it's pretty good deal. But most of those people are, as far as I know, all of those people are buying existing properties. But that's a really good way to get somebody in a house when you're living outside of a metro area. I think it's the best deal going. It's better than FHA.
Yes, yes, USDA, a lot of people definitely overlook. Um, but one of the things that, because I just talked to someone at the USDA office in Georgia last week, and she was saying that they have a 1 year wait list. So if you are looking into, taking advantage of those programs, you definitely have to consider the timeline that you're looking to stay within. So it is an amazing option, though, if you have the time. You're not looking to move right away, or you don't have to move right away, to utilize those resources that are available to you, because USDA also does construction. Am I correct?
I, you know, it's where I'm sitting in Alpharetta, Georgia. We're not seeing a lot of USDA. We're definitely
Right.
not seeing USDA construction. We see very little FHA. My market and your market are not necessarily the same. Like, we don't do a lot of VAs up here. You probably don't do a lot. You might, with people living with Augusta being a big
Yes.
vet
You
place.
do a lot of VA.
Yeah.
Yes.
So I'm about normal stupid on all of those, right? I know enough about them to talk about them, but I'm not in depth like somebody that does a whole bunch of VAs or a whole bunch of USDAs. So
Right.
I'm under the impression you can still get a USDA loan.
Mhm.
So that's interesting that you said they tell you all the money's tied up and there's no USDA loans right now.
They did. They said that it's pretty much a 1 year wait list right now on obtaining the USDA funding, and to be able to take advantage of the different programs that they have, because they also have a down payment assistance program that would help with some of the cost, and potentially some of the closing costs as well. So yeah, it's an option, but it is definitely something that takes quite a bit of planning. It's not an immediate thing. So, but what
But
is
you know what is immediate is if you want to go buy something and you want to do an FHA or a conventional mortgage and put 3% down, then you can get a gift from a relative. So you get a relative give you $10,000, you're in, or less, depending on what you're buying and what the price point is. But
Mhm,
um, that's what I see a lot of youth doing,
mhm.
right? You get grandma or somebody give you a
Mhm.
gift of 10 grand. So you don't even have to have your own money, get the seller to pay the closing costs. So if you really
Right.
want to do it and you got family that's got the means to help you a little bit, that's a great thing to do.
Right. And that's one of the things that I always tell buyers, that don't disqualify yourself before you step in the game because
True.
there's so many different ways that we can play it. I mean, when you have a good lender and a good realtor on your team, we will come up with options and solutions that you didn't know that were possible. And like you said, a gift. A lot of people don't know that that's an option for them, that they can get a gift from a family member. And they're struggling or worrying about trying to get the money, when you would pay a lot less interest if you took out a loan from a family member versus taking out a personal loan to pay your down payment. So you
Right.
know
Yeah, but it's still the number one thing to think about right now is that we're kind of back to a normal situation, and that if you go, the rates got so low that for a time there you could buy a house and pay the same as you do in rent. Well,
Right.
now that's not really the case, right? If you buy a house, if you're paying $1,500 a month in rent, you're going to probably end up with a $2,000, $2,200 mortgage payment. But I
Right.
tell people all the time that $300 or $400 of that every month is going to reduce that principal.
Mhm.
So what people don't think about is, rent, you're just kind of throwing it away. But when you buy a house, what happens is you're paying the mortgage down and the appreciation's going up. So it looks like this, right? So you're gaining both sides of the equation, and the longer you stay there, the sexier it is. Because I'm 66 years old, and I look back at the house that I bought for $160,000 when I was 30 years old, just sold the other day for $950,000.
Wow. Wow.
Okay, so that's been 35 years, which is a long time. But I tell people all the time, I wish I'd have never sold any house that I ever bought. If I could have kept every house, the longer I would have kept it, the better it make sense. But you know what happens? You get in there and you buy a house for 160 and it gets up to about 200, and you think, man, I'm gonna sell that, take that equity I'm gonna get out of that, I'm gonna buy me a 300. Then you make some equity there and you go buy you a 400, and you move up the ladder. But the friends of mine that have not done that, they've not taken their equity out. They rented that house out. They bought a house, they lived there for a little bit, rented it out, saved up a little money while they were there, went and bought another house, blah, blah,
Right.
blah, which is what I'm teaching my kids to do. Next thing you know, you turn around, you got 4 or 5 houses, and you got
Right.
a net worth of 500,000 to $1 million in 5 or 6 years. It's crazy.
Absolutely. Absolutely. And that's definitely the play. That's the way that you should be thinking. Because there's so much that you can do with your assets. And a lot of people don't realize that too, that assets can also be qualifying income. So let's talk about that. What about the people that have a ton of money coming in every month, but they have no assets, versus the person that has tons of assets and maybe a little less income?
Well, our business is set up for what we call cash flow. So if you got a guy and he works for the city and he's got a regular paycheck coming in, we know that paycheck's coming in. We qualify him off of that. But let's say he's got a grandmother and she's got $500,000 in the bank and she doesn't have any income coming in. She's harder to do a loan for than he is, because she's is all assets. Now, if you go to the bank, it's the opposite. You go to the bank and they're like, oh, if you don't pay, I got this $500,000 I can come get. You lose your job, I got this $500,000 I can come get. The bank loves assets, but the mortgage guy loves cash flow. We just want to see you got a job and how much you got coming in every month, and then what are your payments every month. So you want to keep your payments low, keep your income as high as you can get it, and you qualify so much better. But they're coming out with some loans because we've got so many people that are getting to be my age, or selling their business or retiring. That bottom line of that baby boomer generation is a pretty big group of people, and they're buying a home and they don't really have a job. And
Mhm.
so how do we qualify them? And so one of the main ways that we're doing that in this area is that when let's say you work for Coca-Cola and you retire. Well, when you retire, your 401k, you have to roll that over, they call it, into an IRA. In other words, move it out of the Coca-Cola 401k program, go put it with an advisor like a Wells Fargo, Edward Jones guy, and he
Right.
takes that money and puts it in an IRA. So it's not in a 401k where company match, it's in an IRA now. Well, what we can do is we can take that money that's in the IRA and we can say, we're going to pretend that that IRA is your job. So if you
Mm,
had $360,000 in an IRA, then we say, how many months can you take money out of that IRA for 3 years? So 3 years, right, is 36 months. So we
mhm.
can give you $10,000 a month in income. So what you have to do is take the first and second distribution. So you go to your Edward Jones guy and say, I want to start pulling $10,000 a month out of there. And I need you to write me a letter that says I'm going to pull $10,000 a month out of there. And so he writes me a
Gotcha.
letter. And so I qualify you with $10,000 in income, even though 360 is all you got.
Right.
It's a
Well,
wonderful program.
that's a great program because that gives people options. And if they have that money sitting there, but they don't necessarily have that cash flow every month, so
It's a great
that's
option.
good to know that that's available, and
Yeah.
especially if you're in the Atlanta area, and where everything is skyrocketing, and people have non-traditional means of income sometimes, so they may have money
Right.
just sitting in the bank. But that's so if we're looking at purchasing a home in Atlanta today, what does that look like? Where are we sitting price wise in Atlanta, Georgia?
It's hard to find something you will live in for under $350,000 in the metro Atlanta area. There are some. I had a guy call me this weekend, wants to buy a $250,000 condo. It's a
Mhm.
1 bedroom condo. It's built in the 70s. It's old. But
Mhm.
you can do that, but then the HOA dues get pretty goofy on those older condos because they're always needing to do some repairs. You might get hit with an assessment, might be
Right.
1,000, might be $10,000 assessment. So it's a little bit of a risk there. But for the average person to go out around here and to find a 60s, 70s brick ranch or a townhome that's 20, 25 years old, I'd say it takes about 300 to 350,000. Now the problem with that is your average person can buy 4 times their annual income. So let's say you're a new school teacher, and let's say you make $60,000 a year. So 4 times that is $240,000. That's about what you can buy. And so you can't hardly find anything. So what we're seeing is single people who are kind of fresh out of school, even if they don't have any student loans, it's hard to go find something to buy. So some of those people can get a gift from a relative if they don't have the money to put down. They can go buy that 350. And so then what happens is if they can go get a roommate or two, we can get them in there by getting a parent on there or helping them put more money down to get their payment in line to qualify them. But once they get in there, they can get a roommate or two. If you buy a 3 bedroom townhome, you get 2 roommates. In Atlanta, you can get easily $750 a room, maybe as much as $1,000 a room. So you got a $3,000 payment, you got 2 roommates for got almost $2,000. You're living there for about what you would be paying. So it can be a way to it can make sense. You just gotta find a way to do it. But that's killing our market for first time home buyers. Most of our first time home buyers are couples, are either single people whose parents have the means to help them, with some down payment. That's what we're seeing.
Right, right. And Atlanta has been appealing, I guess, for the last, I would say, 10 years or so. Definitely the last five, things have changed drastically. Um, and so a lot of people will ask, especially so the people that are from these areas that are moving out. Maybe they're getting a nursing job. Maybe, they're getting into a high paying job in cybersecurity. And, they're wondering, where do I keep my debt? Where do I keep my debt ratio so that I can qualify eventually for a home? Because I know that I have the income that I need. But where would I keep my debt ratio?
Yeah, if Fannie Mae wants it under 45, you can do FHA and VA up to 55% of your total debt. But you have to factor in what the new house payment is. So you take your new house payment, your car payment, your student loan payment, your charge card payment, whatever the minimum monthly payments are, and divide that into into your income. So if you make $5,000 a month, all that needs to be about $2,500 of debt, and that's where we struggle with the first time home buyers unless they've got somebody to help them on that. Now, what's cool is you get a person that's school teacher again making 60, and they're married and their spouse makes 50, 60, 70. Let's say makes 60. So now you got 120 in income. Now you can buy 4 times that. So now you're at 480. So now you can buy a $350,000, $400,000 house, assuming that there's not excessive debt. But we're running into, it's 50-50. We're either seeing kids who got no debt, or we're seeing kids that got a lot of debt.
A ton of it, right?
It's not like nobody's got $15,000 or $30,000 worth of debt. They either got zero or they got like 75 or 100. It's the craziest thing I've ever seen. So those folks that have got $75,000, $100,000 worth of debt, it's just really, really, really tough to get you into something unless you're got a spouse to go with you that maybe doesn't have that debt to kind of help you offset that to get you in.
That's a good point. And it's so hard. I always say it's always harder for the generation after us because these kids coming out of college, obviously school, cost, and they're getting these high paying degrees, but that comes at a cost. That may come at, you're paying for grad school, you're paying the tuition, and now I've got all this student loan debt. And
Don't do it.
It makes it a little hard. It makes it harder for And so what do you say to that person that's got all this student loan debt because they've gone to school to be a doctor and now
my grandfather was a painting contractor. He wanted his sons to go to college. My dad goes to college, then goes to medical school, paid that debt for almost his entire life. Okay. I go to college, flunk out, get in the mortgage business, and within 5 years, I'm making more money than my dad as a doctor, and I got no debt.
Yeah. And that's the position that a lot of people are in. It's like, you think that's what you do. You do well in school, you go to college, you get this degree, but then by the time you go through all of it, you've got so much debt because not only do you have to pay to live while you're in college. Some people can stay with their parents, but some have to pay to live while they're there. So they're accumulating debt through this.
The government gives you the money for free. There's no qualification. It's the only loan I know of. All you have to say is I'm enrolled.
Right.
It's stupid.
Right. And just sign your name on the dotted line.
Don't get me started. And people will do that, and they're enrolled, and they'll get the $3,000 or $5,000, and then they'll flunk out during the semester, and so that money it was wasted.
Nowhere. You're still responsible for the debt whether you finish or not. And that's just it. And so it's putting a lot of people in very tough situations where they're not able to achieve home ownership. So tell us a little bit because I talk to people about this all the time, about how they calculate your student loans into your debt ratio.
So what we use, Fannie Mae uses 1%. Okay, so if you have $10,000 worth of student loan debt, we count that as $100. Assuming if you're in a payment plan and they've given you a payment, we use that payment just like a car payment.
Mhm.
If it's showing that it's in deference for whatever reason, then Fannie Mae makes us use 1%. FHA makes us use 0.5%. So if we got somebody with a lot of debt, we're going to try to push them to FHA or Freddie Mac just to get their ratios down to where it'll work.
Mhm.
If they can manage the debt, then we use the 1%. So
Got
I mean, it's 0.5%. I mean, if you had $10,000 on your charge card, I mean, I don't know, that's probably $300, $400, $500 a month minimum payment. But if you got 10,000 on your student loan, when we're only going to charge you $50 against you,
Mhm.
that's pretty good.
Right. Absolutely. And so
So,
if they've got some money in their account, do you ever recommend that someone just pay down some of their debt? Maybe not student loans, but maybe your
well,
credit card debt to be
yes,
your ratios look better.
credit card's number one because it also moves your credit score up. So, real quick, if you have an installment loan, a car payment, and you have less than 10 months, 10 payments left on that car payment, then we don't even count it.
Mm.
Okay. If you've got, a, something else I was going to tell you, revolving, if you got a charge card and that charge card says you can go to $1,000 high credit limit, your
Mhm.
goal is to keep it at 1/3 of that. So if you keep it below $300, then your score is going to be great. If you keep it
Mhm.
more than 2/3, they're going to hammer you on the score. The sweet spot where your score stays the same is kind of that middle third, right? $300 to $600.
Right.
The ironic thing is that your score is based upon that moment in time that I pull your credit report. So if you just got back from a cruise and you owe $1,000 on your credit card and I pull it tomorrow, you're going to get a bad score. But if you paid it off 3 or 4 weeks ago and it's showing that you only owe $100 on that credit card, then I'm going to come up with a better score. That is the reason why somebody says they pulled my score 2 weeks ago and it was 680. Why is it 620?
Right.
Depending on where it was at the time.
Yeah. Yeah. And how the score can fluctuate, because I think people also on the flip side of that think that if I pay it off today and you pull my score tomorrow, it's going to show up.
Not that soon, typically. So, each credit card has a cycle, right? So when you pay during that cycle, then they report it whenever that cycle is, when the next cycle is, and then it shows up after that. But, I don't know. I mean, we find that you got spenders and savers, right? We got people coming in here and they don't owe jack on their credit card. Then we got people coming in here and they're maxed out on every credit card.
Right.
So even though they paid it all down and went and got a loan, they'd run the damn thing up again. That's where I'm at. So I just don't keep any cards. I just keep cash in my pocket. When it runs out, I got to go find some more cash because I'm a
Right.
spender. But my brother's a saver, right? He probably got way more credit cards than I do and probably go real high balances, but he don't owe anything. So
Right.
another thing that people don't know is the longer you keep that same credit card, the better your score. So it looks at how long. So a lot of people used to move their cards all the time because they would get, somebody pay them a little higher interest, or they have 12 months they have to pay, or they're
Right.
paying 1% back and this is paying 2% back. You need to kind of get set in with somebody and kind of hang with that card for a while. The longer you have that card, the higher your score is going to be.
Right. Absolutely. And going into that, if you see a card on someone's credit when you pull their application, if they have a low balance and it's on a new card, so that affects their credit age, is it better for them to just pay off that newer card and close it, since it's a newer
It's a
card,
catch
it
20.
doesn't have much
Yeah.
impact?
The low score will a little bit offset the new card. If you got a new card that's maxed out, they're going to wham you. If you don't have a new card and you don't have any new, like we'll see people, they got a card 3 or 4 or 5 months ago and they tell me last year my score was X and now it's down to here. It's because you got a new card or two depending on your credit depth, how long you've had credit and how many pieces of credit you've got. So there's all kind of stuff that goes into it. But basically, I tell people is you want to be like your grandmother, right? She's got two charge cards, and they both go to like $10,000, and she never uses them. But when she does use them, she bought some Christmas at $1,000, and that bill came in, and she paid that sucker off the next day, and she's had that same credit card for 10 years.
Right.
That's your 800 credit score.
Yeah. Yeah. The not utilizing, I think people have the misconception that when they give you that money, that it's yours, it's all yours to spend. And I think if people would stay below that 50%, 40%, ideally 10%, but realistically speaking, it would benefit them, especially when you are applying for a mortgage. And so one of the things,
you got to live in your means, right? That's the bottom line. If you really want to gain, you got to live it in your means. And because the reason why real estate works is people will really sacrifice and kick and scream and try to find a way to get in the house. And that's the reason why it's most people's asset. Once they get in the house, everybody in town knows they live in that house, and they're going to do everything they can to not lose that house. It's going to be the last thing they lose. You can come get their car, but they're going to try to stay in that house.
Right.
And that's why in the long term, residential real estate works for most people. It's your biggest asset.
Yes, absolutely. And especially like you said, if you ever get to the point to where you want to rent out that asset and move up or move down, you could rent that out and potentially make some really good income, have some cash flow coming in, and you're building equity at the same time, but someone else is paying off that asset.
So
So
here's how you become worth $1 million in about 10 years. You go buy a house for $300,000. You put 3% down. That's $9,000. You buy the house. You live there for about a year, maybe 2 years. In the meantime, you save up your next $9,000 or $10,000. Right? You go find somebody to rent that house to cover that mortgage payment. And then you go buy the next house, but you don't go buy a $500,000 house. You buy one next door. You buy the same kind of house. Move sideways. Don't move down. Don't move up. Move sideways. Right.
okay.
And all this needs to be where you can drive by and look at it every day. Because if your tenant knows you live in the hood, so to speak, they're going to keep it up a little bit nicer than if you're living in Atlanta and you got a rental house in Crawfordville. So go buy that second house, live there for a year or two, put 5% down on that. Then go buy another one, put 5% down on that. Normal appreciation for residential housing is about 5% a year. Each one of those houses going up 5%. Somebody's paying it down 1%. You're gaining about 6% a year. In about 10 years, you look around and you've almost doubled what those houses are worth. Plus, people are now paying you more than what the rent is worth. I mean, what the mortgage payment is. So now you got cash flow and net worth. It's the way to go.
Absolutely. Absolutely. 1000%. And so I'm just curious because, I come up there probably once or twice a year these days. It used to be like once a month, and then it kind of dwindled a little bit because I've been so busy. But tell me, what's your favorite restaurant to eat in Alpharetta now?
Well, I eat almost every day at a place called Never Enough Time. It's what I call a chick restaurant. It's got the salads and the chicken salads and the quiche because I'm trying to stay healthy, and it's close by, and it's sort of like the little local spot. So I eat there a lot. But I'm excited about we've got a Little Alley Steakhouse coming to Alpharetta. They've got one in Roswell. It's one of my favorite steakhouses. And then we've got a really good place called Lapeer, which is sort of a steak and seafood place. So I'll eat in downtown Alpharetta. As you know, I live downtown. I sold my car. I walk everywhere. I walk up for a cup of coffee. I walk up for lunch. I walk up for dinner. Walk up to meet somebody for a beer. So I'm walking to downtown from my house, which is about a half a mile away, 2 or 3 times. So I eat it all up. I spread my love around town. I try to eat, different places all the time. We got some really good spots.
Yes.
It's hard to, we're lucky. This is I just got back from doing a trip down the West Coast. One of my bucket item trips for my wife and I was to drive down the whole West Coast. So we flew into Seattle, rented a car, and drove it all the way down to San Diego. Took us
Nice.
about 2 weeks. Saw all the cool stuff down through there, like the redwood forest and all that. But I'm telling you, I could not wait to get back to Alpharetta, Georgia. I mean, Georgia's
Really?
so
How
nice.
awesome is that, though, to
We
experience?
got trees. It's green. Our weather's good. I was in Seattle, and it was miserable and raining and
Oh,
grungy. And I told the guy, I said, I'm leaving a day early. He's like, man, you got to come back in August. I said, that's the problem. You only got August. I
right?
got 9 months in Alpharetta, Georgia. You only got 1 month. And I couldn't wait to get back.
I know. But, I think going other places makes you appreciate what you have.
It
And
does.
let you go other places and you see, like I know I went up to Chicago and everything you don't have all the greenery that you have here. And so one of the things that I missed flying back to Georgia is I was like, oh, I'm so happy to see green.
Just look out the airplane window.
Right. Right. And Vegas too. Vegas will make you think, well, can I see some color?
Yeah. I couldn't wait to
Everything.
get out of Vegas. I went out there to the Sphere. Have you been to the Sphere?
I have. So I went when it first opened because we saw them building it and I was adamant about, making sure that we went back. So, but we go to
I'm
Vegas
done.
like
I ain't
2-3
going
times
back
a
to
year.
Sphere. I'm not going back to the Sphere. Because you sit there, it's like watching a movie and the music's playing. You can't even see the band. If you got a good seat, you want to sit as far away as you can so you can see all the screen. And I'm like, I'd rather just go see the band.
Yeah. Oh, so you went and saw a concert there.
Yeah.
Okay, gotcha. So I just went to
I'm
see
glad I did it. It's like Stone Mountain. I'm glad I saw it, but I don't need to go back.
Right. Well, you can check that off your list. Check.
It's checked.
Well, awesome. Well, tell people how to find you for all the people migrating and trying to get to Georgia, and more specifically, Alpharetta, the Hollywood of the South, as they call it.
Yeah.
Tell people how to find you and connect with you.
You can find me on my website, hometownmoney.com. And it's Hometown Mortgage, but our website's Hometown Money. You can reach me, Steve, at hometownmoney.com, or you can call me at 770-634-2531.
Perfect. We appreciate you coming on. Thank you so
Kristen.
much for all of your knowledge and sharing everything. As always, it's been a pleasure.
I love it. Hope to see you soon.
Yes, of course. Especially once we find that land, that hunting land that you're looking for.
I'm going to find it soon. I'm ready.
Yes.
Give me some cows, and you got to come out there and help me rope them.
Yeah. Well, I don't know if I'm that country yet. We got to see.
All right.
Have a
Great
good day.
talking with you.
Thanks, Steve.
All right. Bye.
Bye-bye.